Hello, everyone. Welcome to our first slideshow explanation, if you will, for Chapter 1 of Tax Accounting this semester. We're grateful that you've joined our class and glad that you've jumped in to learn some information and how to apply it, having to do with federal income taxes. So that is our topic. We're not going to cover excise taxes, sales taxes, payroll taxes, a little bit of payroll taxes, but most of them no. So we are focused fairly narrowly on federal income tax. We're not even going to deal very much with state income taxes as they differ from all 50 states, some of which don't even have an income tax. So we're talking about federal income taxes and the laws that govern that and how to make that work. So we haven't always had an income tax as a country. There was one during the Civil War and repealed after it was ended because that cost an immense amount of money to fight the Civil War, and so they had that tax. Then they passed it again in 1894 and was told that the Constitution, which said that it could not be portioned by income, did not allow for an income tax without amendment. And so in 1913, the 16th Amendment to the Constitution was passed, and therefore the income tax became legal, and wasn't long after that before we had income tax. And it started off at a very small amount, very low rates, and only applied to the wealthy when it began. It is now much more robust and affects a whole lot more people. As you can see, in 2021, the most recent year available, it takes a couple of years for the IRS to release the statistics of statistics of income is what they call it. And so in 2021, 168 million income tax returns were filed. That's just for individuals. That's not business. That's not partnerships, S corps, or any of the things that we will cover right at the end of this course, but just the individual income taxes, which brings in by far the most money of any of the taxes. 151 million of those were filed electronically. IRS greatly encourages electronic filing. It's so much easier for them to process if it comes in electronically. And that's about 90% of them. And it's actually been higher. 2021 was actually a dip down in the percentage, at least. And that represented about $2.27 trillion in 2021 coming in because of the income tax. So that's the kind of numbers we're talking about, which is still not the majority of the federal budget, but is a significant portion of it. So let's talk a little bit about the different types of tax systems. Uh, Typically, we calculate taxes by multiplying a tax rate, how much a percentage, by a tax base. So basically, tax law is about those two things: that what tax rate gets applied, and what income is subject to that tax, the tax base. Okay, most of it by far is the amount taxed. The tax rate is a relatively straightforward concept in terms of the amount. There are some twists and turns, though, in calculating that we'll learn about. Okay, so it may represent multiple rates for multiple on multiple bases. Okay, so it literally could be different rates for different amounts of income. Okay, we in the United States have what's called a progressive tax structure. That means the tax rate that is charged or is paid, okay, increases as the tax base increases. As your income goes up, you move to another tax bracket. you pay a higher rate, a higher percentage. Okay, so let's just look at this. Go ahead, we'll jump back. But this is the tax brackets, if you will, for married filing jointly, and we'll learn a little more about what that means in chapter 2. But just so you understand the tax rate scenario. So if your income is 0 to 22,000, your tax is just straightforward. It's 10% of that. Okay, if your income is 25,000, then your tax is 10% of the first 22,000 still. And then the amount over 22 up to the 25 is 12%. If your income is 100,000, then you pay 10% of the first 22,000. You pay 12% of your income between 22 and 89, and then 22% of the amount over 89,451. That's what we mean by different rates apply to different parts of your taxable income. So even if your income is $1 million, you still pay 10% of the first 22,000, 12% on 22 to 89, 89, 20, I mean 22% of 89 to 190 and so forth. Okay, so that's what we mean by tax rate and the tax rate table and tax brackets, if you will. Now, our rates go up. If the tax rate is the same no matter how much the income, then it would be what's considered a proportional tax structure. In Pennsylvania, for those of you who are participating from Pennsylvania, and several other states are like this, but there are states that have a progressive, but Pennsylvania has a proportional tax structure. The rate is the same regardless of your income. It's just over 3%. Whether you make 10,000, okay, you don't have to have these different brackets because it's all the same. So if you make $4,000, your tax is 4,000 times 3%. If you make $400,000, it's 400,000 times 3%. Okay? And then a regressive tax structure is where, as the tax as the income or the tax base increases, you pay a lower amount. So there's actually the Social Security tax system, which has a rate up to a maximum, and then after that you don't pay the Social Security tax. So it goes to zero because the amount of income over that is not considered in calculating your Social Security benefits. All right, that's our tax rate structure. This is recreated in your textbook at the end in Appendix F. So we're almost on the very back cover. Now, a couple of terms that we're going to run into as we talk about taxes. The average tax rate is just take your total tax and divide it by your taxable income, or whatever income is subject to the tax base. It's the term that we used on the earlier slide. Okay, so you just take the tax that you calculate, however it is, and divide it by your income. Pretty straightforward. The marginal tax rate is the rate of tax that will be paid on the next dollar of income. So that's determined with reference to the tax rate schedule we just looked at. Whoops, went past it. So as the slide said, if you're married filing jointly and if your income goes from $89,451 to $89,452, so you make one more dollar, marginal, it means the next dollar, that next dollar will be taxed at 22%. Even though income lower than that, if you went from 80,000 to 80,001, your that dollar would only be taxed at 12%. And if you went from 21,000 to 21,001, that dollar would only be taxed at 10%. So that's what we mean by the marginal tax rate. The next next dollar of income, what is it taxed at? Because that's what makes people's decisions. You make decisions in business and in personal based on your marginal tax rate, not on the average. So our class and our chapters that we're going to cover are going to revolve around this income tax formula. So we're going to start with all income. Basically, the tax law says all income, no matter what form you receive it in, is taxable unless specifically said otherwise. So you do something for someone and they pay you in Jelly Bellies, that is income still. That really is total income. Then you subtract from that, okay, permitted deductions from income. Later, we'll find that there are certain income that you can also exclude from that first definition. But right now, we're just going to say that all income is included. Then you subtract out what the tax law specifically permits you. And for chapter 1, we're only going to have one permitted deduction, and that's the standard deduction. Later, like in chapter 5, we will learn, and chapter 4, we'll learn about other things that can be subtracted to get your taxable income. But right now, we're just going to start real simple, and we're going to have one standard deduction. It will vary based on filing status, which is a term we'll learn next week in chapter 2. Equals our taxable income. Straightforward. Then we apply the tax rates, which we just looked at, how we might look at the tax rates. And that's going to equal our tax liability. That's how much we owe. But then the tax law provides for things like our tax credits that are like you paid it already because you do certain things. And we'll learn about that in chapter 9, what the different tax credits. If you've made prepayments, because guess what? The IRS doesn't want to wait to get all your money. They're going to make your employer withhold money from your paycheck, and and send it to the IRS for you. That's included in tax payments. And then at the end, you're going to either have a tax refund or a tax due, depending on which is more, your tax payments and tax credits, if they're more than the tax liability, or vice versa. So what really happens when we file a tax return, okay, is that it is simply settling up. It's showing the IRS that what we paid already or didn't pay already and what we owe are different, and if they're same, then we're all taken care of, or if it's different, then either they send us money back or we send them more money in. That's referred to as Form 1040. There is no such thing anymore as easy form or a simplified form. It is 1040, and then there is a senior form, 1040 SR, for those over 65. Okay, so that's the only two individual tax forms that we file now, that we can be filed. And then to keep the 1040 from being immensely long, we have what's called Schedules 1 through 6, okay? And those will depend on what kind of income and deductions you have, that you will use those schedules. And then we'll learn some others even beyond those 6. That's the first line. And then there will be additional schedules that will explain amounts on the 1040. Or will be used to add up things and amounts. And we're going to use some tax software that will automate that. But if you don't know what those are, it's going to be difficult to use that software. Okay? They all work for the basic income tax formulas. You get more and more schedules, the more complex the return is. All right, so just to give an example, some of the things that happen on a simple 1040. Wages are reported to the taxpayer on their W-2. They receive that from their employer. We look at the income on box 1. It goes on line 1 on the 1040 as wages, which includes a lot of things that we don't often think of as wages, but are considered that same thing. Okay, so that's put on the 1040. Another thing that comes up a lot is interest income. We'll get a 1099 INT from the bank. This is interest we receive in our account for having money at the bank. Up until recently, it was hard to get any interest income because the rates were so low. But recently, interest rates have gone up, which of course has made it much more expensive to buy a car or a house. But it's also allowed you to earn some interest if you had additional savings available to put in the bank. So you get that interest income, and that is reported on the 1040 on another line. Okay? Other things that might come to you, you'll get unemployment compensation is taxable, and you get a 1099G. G for government, because that's who pays you the unemployment compensation. Any payments from governments the report on it, just like a W-2 comes from your employer, the 1099G comes from the government telling you that you were paid this amount of money. And then you can put it on the 1040 to settle up, if you will. Subtract out the substandard deduction, and like I said, is the only deduction we know about in Chapter 1, okay? And that is $13,850 for single. So basically, until you've made more than $13,850 in income, if you're single, there's no income tax. So you get the first $13,850, if you will, tax-free. And if you're a married couple, you get double that, $27,700. So take that total income minus the deduction, and that gets you your total income. So if I'm asking for total income, I want it before you subtract the standard deduction. If a problem or homework or whatever asks for taxable income, okay, you need to subtract the standard deduction before answering. And you always calculate the tax liability based on taxable income. So you need to subtract out the deduction, or if it tells you that the problem already has calculated taxable income, then you can go right to the calculation of tax. But it's important to read carefully what is being asked for. So how do you calculate? You got the taxable income figured out. How do you calculate the tax? If your taxable income is $100,000 or less, you use the tax tables. These are printed in your appendix into the textbook. You can also find them on the instructions to Form 1040 on the IRS website. Okay, if your income is over $100,000, so technically $100,000, you have to use the tax tables. Okay, you will have a homework problem that will have you do it both ways, but technically, your taxable income is up to $100,000. You use the tax tables. Over $100,000, you use the tax rate schedules, similar to what we saw in our earlier slide for the married filing jointly. Okay, they will come up with slightly different answers because there is some estimating being done on the tax tables. Okay, and you'll see that there's a difference. It's typically a couple of dollars, maybe $1. It's not significant. It's not going to make a difference. So technically, you could use either one. All right, you should come up with roughly the same. Obviously, the tax tables can't use for over $100,000 because they don't exist. Okay, nobody has made the tax tables. Okay, so just to look at that, this is what a tax table looks like. You see, a little small, I apologize. Okay, but you see what the income is, and you see that it looks at it at a range, $50 range. So $75,000 to $75,050, and then you have to know your filing status, and we'll explain that more in chapter 2. Okay, but it will be given to you any homework problems. If they want you to find the tax liability, and they give you the taxable income, or you calculate the taxable income, then you find it where your income is. It's between those two, okay? And if you're single, there's your tax liability. Married filing jointly, there's your tax liability. Married filing separately, there's your tax liability and head of household. Okay? So that, and then if you, different taxable incomes go in these brackets, and you see that there's just a $50, but all those people with income between those two pay the same amount of tax according to this tax table. Well, reality with the rates and stuff, it's not the same. So this is estimated, basically pick the middle point of that and calculate the tax on it. So that's why it's slightly different, the tax rate schedules. Okay, as shown over here, for single, the one we saw earlier was for married filing joint. Single, okay, again, your taxable income from 0 to 11,000, just pay 10%. From 11 to 44, you pay 10% of the first 11,000 plus 12% of the amount over 11,000. If your income's in these two, you pay 10% of the first 11,000 plus 12% of the difference between 11 and 44, which they've already calculated for you as 5147. So this 5147 is the 1,100 plus the amount, 12% on the amount between these two, and then 22% of anything over 44,725. That's how you apply the tax rate schedules. Again, you have to have the taxable income. This applies the same way. All right. Now, again, technically, up to 100,000, you have to use the tax tables, which uses this, but it kind of rounds, you might say, it off. If income is over 100,000 taxable income, then you have no choice but to use this method, the tax rate schedule. Okay, typically, as we mentioned earlier, your tax liability is paid throughout the year. It's withheld from your checks, reported on your W-2. There also may be tax payments, okay, or credits that we referred to, like, especially for those of lower income, the earned income credit, which we will discuss several of them in chapter 9. So the tax return is settled up, like we mentioned, and is due on April 15th. That's the date to file. All right? They want the payment all along. They don't want to wait till April 15th to get the payment. And in fact, you could owe interest if you pay your liability entirely on the 15th. There are extensions available, okay, for the tax return. And the thing that I remind students of, it is a extension to file, not an extension to pay up. It does not stop the charging of interest. Anything you don't have paid, technically, all along, that you owe on April 15th is generally charged interest all the way up until you take care of that, no matter where you actually file your tax return, okay, even if you use up the 6-month extension. Okay. If you have greater tax liability than your payments, you owe them. If there's liabilities less, you receive a refund. All right, that's the end of this first part of the chapter 1. Second part has to do with the appendixes in your reading and how we find the tax law in our research if we need to find out what the law is with regard to a particular matter.